In this module, we are going to begin our study of what is called macroeconomics. Up until this point, we have been studying the microeconomy. We've been studying the decisions of individuals and households and different firms and businesses and how they make their individual choices about how much to demand of a good or service or how much to supply. But now we're going to turn our attention to the study of the economy as a whole. And it's important for you to understand how the economy as a whole works because you will be living your entire life making economic decisions. And if you can predict what will happen with the economy or what is likely to happen with the economy as a whole, you'll be able to determine how it might affect you personally and the choices and decisions that you will need to make to better your outcomes as a result of that. So first, we are going to look in this module at the idea of measuring national output and income through what is called the gross domestic product. The gross domestic product is a measure of the value of goods and services produced in the economy each year. And as you can see here from the key idea, it is the most widely used gauge of economic activity. More than any other set of economic data or economic indicator, this is the one that tells us how well the economy is doing in terms of its health. If we are increasing our gross domestic product, then we say there is economic growth and the economy is growing and that's getting better. If, however, the economy is slowing down, we say that it's contracting and gross domestic product will be shrinking, and that's not something that we want to contend with because it leads to all kinds of economic problems for people. So as we study gross domestic product in this module, we will accomplish a couple of objectives. First, we will explain what gross domestic product is by defining it and how we actually measure it. Then we will identify what is not included in gross domestic product because while there are many things we do include, there are some items that are not included. From there, we will discuss the difference between real and nominal values, and then we'll conclude by explaining why real gross domestic product is the most useful measure of a country's total output. So let's begin with a definition. To understand gross domestic product, we have to define it and know what is included. So here's a definition. A nation's gross domestic product, otherwise known as its GDP, is the total dollar value of all final goods and services produced within the country's borders in a given year. But that's a mouthful. There's a lot there. And what we need to do is to unpack this definition and take it apart piece by piece to determine what actually is included in the calculation of our gross domestic product. So let's begin with the first part of the definition, the dollar value. When we measure our country's gross domestic product and we're measuring all of the goods and services that we produce, we could do it a number of ways. We could measure it in terms of the quantity of goods and services. We could measure it in terms of pounds. But the problem with that is that it wouldn't give us a very accurate measurement. For example, if we were measuring the number of tortilla shells we produce and the number of automobiles that we produce, if we produced 5 tortilla shells and 5 automobiles, we'd say that's a quantity of 10. But the value isn't the same. A tortilla shell is worth far less than an automobile. And so quantity isn't really a very good measure of our gross domestic product. And the same thing if we measured in pounds. What if we looked at tortilla chips and we looked at computer chips? Well, we could produce equal quantities of tortilla chips and computer chips, but the problem with that would be that if we measured it in pounds, tortilla chips are much lighter than computer chips in some ways, and yet computer chips are much more valuable. So while we might get a similar outcome in terms of pounds, it wouldn't be very accurate. So the best way to measure our gross domestic product is to assign it a value based in dollars. How much is that product worth? And then we can measure changes accurately. Each good or service enters GDP at its dollar price, so a pair of running shoes that you buy for $100 contributes $100 to that year's GDP. The second part of the definition is that we measure goods and services. Now, we know what goods are, but production doesn't only include goods like baseball bats and hamburgers, things that we can touch and feel. Actually, in the United States, in our service economy, 90% of the jobs that are performed are service jobs. For example, I am a teacher. I provide education services to you. And it's not something that you can see. In other words, there may be no physical trace left to look at and hold when you walk out of the classroom at the end of the day. The same thing is true with doctors and nurses and architects and pilots and bus drivers and people that wait on you in restaurants and so forth. Most people are providing services, but those are not tangible goods, but they do enhance the quality of our lives. They make our lives better. Much of what we want are services performed for us. So we have to measure their value. And services, of course, are critical to our well-being. Imagine that the economy continued to produce goods but stopped producing transportation services. Unless you lived very close to a farm, you wouldn't be able to buy food. So services are very important. The third part of our definition is that we measure final products. To measure GDP, we have to include final goods and services, not intermediate products. Now, what's the difference? Well, a final good or service is one that is sold to its final user rather than to a firm that will use it to make something else. A household, such as your family, is a final user, as is a government agency like the U.S. Army. A firm such as Delta Airlines is a final user when it purchases airplanes and other capital goods. But by contrast, an intermediate product becomes part of a final good or service. It's used up in the production process. It's not actually a final good. Examples of intermediate products include raw materials like lumber or semi-finished goods like the computer chip in your cell phone. Coal is an intermediate product that is burned in the production of electricity. Capital goods, however, such as buildings, machinery, tools, are not intermediate products because they do not become part of the final good and they are not used up in the production process. So when businesses purchase capital goods, we call those final goods. But if they use something that they purchase that is part of the final good that they sell to us, then it is an intermediate product. Now, many goods can be either a final good or an intermediate product, depending on how they are used. For example, the flour your family buys to cook with is a final good, but the flour that is used to make hamburger buns for McDonald's is an intermediate product because it's part of their final product, the hamburger bun. Intermediate products are not counted in GDP because they are already included in the dollar value of the final good. When you buy a cell phone, which is a final good, the price you pay includes the value of all the intermediate products used to make the phone. The computer chips, the display screen, the plastic casing, the software. If we counted these intermediate products in GDP as well, we would be double counting them. We only count goods in GDP that are produced within a country's borders. GDP measures production that takes place in the country in which the good is actually produced, regardless of the citizenship of those who produce it. The D in GDP stands for domestic. That means within our borders, at home. So, the U.S. GDP includes all production by firms that operate in the United States, even if they are foreign-owned. So, Toyota, a Japanese company, builds cars here in the United States. Even though it's a Japanese company, those cars are counted for our GDP. But if Microsoft were to produce computers in China, those would be counted in China's GDP, even though Microsoft is an American company. So production that takes place in other countries is not counted as part of U.S. GDP, even if it occurs in firms owned by U.S. citizens. And then the final part of our definition is that we count goods produced in a given year. We only count products when they are finished and ready for sale, not just when they are sold. So we count them in that given year. GDP includes only final goods and services produced in a single calendar year from January 1 to December 31. It does not include the sale of items left over from the previous year. However, those items that are made in one year and sold in the next are counted in GDP in the year in which they are made. So once a good has been produced and it's ready for sale, we count it as part of GDP. We don't count it when it is actually sold. Now let's turn our attention to how we measure GDP. There are actually two ways in which we can measure it. The most common approach is called the expenditure approach. An expenditure means you're spending something, spending money. And so here we add up the total dollar amount of all the money that is spent on goods and services. That's called aggregate demand, or GDP. And it is composed of four different sectors. So we add up all this spending and we divide the economy into four basic sectors: the household sector, the business sector, the government sector, and the foreign sector. We then label final goods and services according to the sector that actually buys those goods and services. So when households, like your family or you and I, buy goods and services for our own personal use, we call that consumption. Consumption would be household purchases made by families and individuals, and this is the largest component of GDP. It includes almost every good or service that your family buys during the year: food, clothes, furniture, movie tickets, dry cleaning services, gasoline, and so on. But there is one big exception: houses. When new houses are built, they enter GDP as an investment by the construction company, which puts them in the next expenditure category. So to avoid double counting, the value of houses is not counted when they are purchased by households. The next sector that purchases goods and services would be businesses. Now, we often think of businesses as producing goods and services, but they are also the final users of some goods and services when they purchase capital. So we refer to business spending as investment, and it's represented with a capital I, just as consumption is represented with a capital C. This includes business spending on three different things. First, whenever businesses spend money on physical capital to buy new equipment, new software, construct new buildings, tools, equipment, machinery, anything that they purchase that is used to make their final goods and services but does not become part of the final good or service is called physical capital. And so they are the final user of it, and therefore it is considered investment. We already said that the second thing that is included is new homes. New homes are counted as an investment on the part of the construction company that built the new home. So it's put in this category rather than in consumption. And then finally, the third thing that counts is what we call inventories, business inventories. These are any goods that are produced but not sold during the year. When goods are produced but not sold, they go into business inventories, and the businesses that produce them are considered the final users for that year until they sell them. So for example, support Ford Motor Company builds a car worth $25,000 in 1 year but doesn't sell it. The value of the car is counted in GDP as an investment in inventory by Ford. Then when the car is sold to a consumer the next year, the value of Ford's investment in inventory would decrease by $25,000 and consumption would increase by $25,000 for households. So these two components of GDP would cancel each other out and the sale would have no effect on GDP. The third sector that purchases goods and services is the government. And that means all levels of government. The federal government in Washington, the state governments, local governments like counties and cities, and even school districts. They purchase goods and services all the time. For example, the school that you're sitting in, the building itself is capital purchased by the school district. The desks, the computers, even the services that they purchase of teachers that provide labor. Those are all purchases of goods and services by one level of government. Governments purchase military equipment, highways, police and fire department services, and so on. So there are many things. So when the government spends money, oftentimes it is on goods and services that it uses. But there is one type of spending that we do not count. It's what we call transfer payments. That is when the government is transferring money from itself to someone else, but it is receiving no good or service in return. So, for example, when the government sends a Social Security check to an elderly retiree, they're not purchasing a good or service. They're just giving money to that person. That is not counted as part of GDP. Or when they give food stamps or welfare payments to low-income people, they're not receiving anything in return for that. They're just giving money out. So transfer payments are not counted as part of GDP because no good or service is actually purchased. And then finally, we have to count purchases by the foreign sector. Those are what we call exports. Exports are goods made in the United States that we sell to people in other countries or to other countries. So it could be any goods, services, or even intermediate products that are made here but sold elsewhere. Those are exports. And in a typical year, the United States exports over $1 trillion worth of goods, such as agricultural products like corn, wheat, and soybeans, pharmaceuticals, and aircraft sold by Boeing, as well as services such as movies, software, and banking services. For example, the United States exports about 30 million metric tons of wheat to other countries every year. And some of that wheat comes from here in Colorado. But there's a problem, because we purchase a lot of goods from other countries. We purchase many goods that are made in China, in Indonesia, in Vietnam, in Japan, in Germany. Those are called imports. Any goods that we buy here in the United States but were made in another country, whether they're intermediate products or goods or services, are not part of our GDP. They're part of another country's GDP, and those are called imports. So if we tried to find GDP by adding together the spending on these four areas, we'd have a problem. Some of the spending in each of these categories was for goods produced in these other countries. Even many of the goods that come out of U.S. factories have some components that were produced abroad. For example, the book you may have with you was written, printed, assembled, and shipped in the United States. All that production is part of U.S. GDP, but the paper for the book is an intermediate product that might have come from Finland, India, or some other country. If so, the value of the paper should not be counted in U.S. GDP. So goods, services, and intermediate products produced in other countries are called imports. The value of these imports is not included in U.S. GDP, which represents production in the United States only. So when we add together the four types of spending, we must subtract out imports to get the proper measure of U.S. GDP. So here is our formula for computing GDP. Households are C, consumption. Businesses, their purchases are called investment, represented with an I. Government purchases are represented by their spending, which is G. And then exports minus imports is what we call net exports, or X minus M. And then when we add those four together, that equals GDP. Now, this last part of the equation, net exports, or X minus M, as you see in this graph, represents net exports. A country that exports more than it imports, such as China, will have positive net exports. A country that imports more than it exports, such as the United States, has negative net exports. As you can see from this chart, in 2011, U.S. exports totaled $2.94 trillion, while U.S. imports were $2.662 trillion. So U.S. net exports in 2011 were negative $568 billion because we imported more than we exported. And this shows the categories for each of those areas. And you can see that the largest part of GDP is household consumption. In 2011, that was $10.7 trillion worth of goods and services. Businesses, by contrast, only purchased $1.8 trillion worth of capital goods. Government purchases were a little more than that, $3 trillion, and exports minus imports were actually negative. They subtracted from our GDP. So when you add them together, C plus I plus G plus X minus M, that equals just over $15 trillion in goods and services produced in the United States in the year 2011. That number is larger than any other country in the world. Our GDP is larger than any other country. The country that is second to the United States is China. Now, the expenditure approach is the most common way of measuring GDP. But there is a second approach that's called the income approach. And when we do that, we add up all the income earned during the year by people involved in the production of goods and services. This includes the wages paid to workers who supply their labor, the rent paid to property owners who supply land, buildings, or equipment, the interest paid to individuals who supply their personal savings for loans, and the profit earned by business owners who provide entrepreneurship. Now remember, every dollar that you spend on a final good or service becomes income for someone else. So the total spending on final goods and services found using the expenditure approach is roughly equal to the total income earned by everyone involved in producing those goods and services. So whether you use the income approach or the expenditure approach, it should add up to the same number for the country's GDP. In practice, though, some adjustments are needed to equate the total of all income with GDP. For example, sales taxes are part of what consumers pay for goods and services, but they are not part of what firms pay out as income, so their value must be added to the amount received as income to arrive at GDP. To understand the expenditure and income approaches better, look at the figure on the graph in front of you. The arrows labeled consumption, investment, government purchases, and received for exports show the flow of spending from households, financial institutions, government agencies, and foreigners to the U.S. firms that sell final goods. When this spending is added together and imports are deducted, as represented by the arrow from business firms to other countries, we find that GDP using the expenditure approach. In 2011, this was $15.1 trillion. Well, where did this $15.1 trillion in spending go? As shown by the arrow pointing leftward from businesses to households, the spending becomes income for the households that supplied the resources for all that production, what we call the factors of production: land, labor, and capital. The income approach is to add the four main categories of income. Wages are paid for labor. Rent is paid for land, raw materials and natural resources. Interest is paid for capital. And profit is paid for entrepreneurship. And so we add that up to calculate GDP. Economists often summarize the income approach with the formula GDP equals wages plus rent plus interest plus profit. Later in this chapter, you'll see that the equality of a country's GDP and its total income can help explain why economies sometimes experience serious downturns. So now that you know what is included in GDP, what is not included in GDP? GDP is meant to include the total value of the final goods and services produced in an economy each year, but economic activities other than domestic production are not included in GDP. We already know two of them. We know that anything produced in a foreign country is not counted, and we know that transfer payments such as Social Security payments or welfare checks are not counted. But there are other economic activities that are excluded from GDP, which include the following. 1. Unpaid work. You know those household chores that you always wished you were paid for but you weren't, like babysitting your brother or sister? The value of that work is not included in GDP. Any work that people do but don't receive money for, we don't have a value assigned to it, so we don't count it as part of GDP. The same goes for volunteer work as for civic or religious organizations. It's not counted. Purely financial transactions are also not counted, such as the purchase of corporate stocks, bonds, gold, or real estate. In these transactions, the ownership of existing property is exchanged for money. But the money is not a payment for new goods and services, so it is not included in GDP. The sale of used goods, such as secondhand cars, furniture, or homes, these were already counted in GDP when they were first produced and sold. When they are resold as used goods, they are not counted again. And finally, production in the underground economy. That represents business activity conducted without the knowledge of the government, such as the sale of items by unlicensed street vendors, or when money is paid for services under the table but not reported on an income tax form, or barter exchanges of services, such as when an auto mechanic fixes a plumber's car in exchange for the plumber fixing his sink. That work is not reported to the government. Those are goods and services being produced, but they're not counted as part of our GDP. Now we come to the final topic for this module. The most important reason we measure GDP is to monitor changes in production over time. But because GDP is measured in dollars, we have a problem. The prices of the goods and services that make up GDP are constantly changing. For example, suppose 10 million cars are made in the United States this year, and the average price of a car is $25,000. then 10 million times 25,000 equals $250 billion worth of car production. That will be included in this year's GDP. If 10 million cars are made once again next year, but the average price of a car rises to $30,000, then next year's GDP will include 10 million times 30,000, which would equal $300 billion worth of car production. The dollar value of car production will have risen even though the number of cars produced hasn't changed at all. Changing prices present a similar problem when tracking any measurement in dollars over time, such as wages, government purchases, or savings. Economists deal with this problem by creating a second, adjusted version of every dollar-based measurement. The adjusted version removes the effects of price changes. As a result, economic measurements based on dollars always have two versions. The first unadjusted version of a dollar-based measure is called a nominal value. A nominal value uses each year's actual dollar values with no modifications for price changes. Nominal GDP, for example, values each good at the dollar price it actually sold for in the year in which it was produced. Nominal GDP is sometimes called current dollar GDP. For any given output level, a general rise in prices causes nominal GDP to rise. This is why nominal GDP is not a good way to judge what is happening to total output over time. The second version of any dollar-based measure is called a real value. The real value is adjusted to remove the effects of price changes. It answers a hypothetical question. What would our dollar measure be if prices never changed? For example, real GDP measures total production in dollars after removing the distorting effect of changing prices. To obtain real values, economists choose an arbitrary base year, such as the year 2005, as shown in this graph. The real dollar value in any year is calculated using the prices in the base year. For example, the figure for real GDP in 2010, according to the graph, tells us what the dollar value of total production would have been in 2010 if the price of every good had remained at its 2005 level. Real values are often called constant dollar values. For example, in tables of economic information, it is common to see that real GDP is measured in 2005 dollars. This tells us that when creating the tables, every year's real GDP was calculating using 2005 prices. Real GDP is immune to the effects of rising prices. It rises only when production actually rises, which is the goal for a true gauge of productivity. This figure shows both nominal GDP and real GDP in 2005 dollars in the United States from 2005 to 2011. Notice that both measures are the same in 2005. The purple bars measure nominal GDP and the orange bars measure real GDP. For that year, both versions are calculated using 2005 prices. In other years, while real GDP is calculated using 2005 prices, nominal GDP is based on the actual prices in the given year. So a change in nominal GDP could be caused by a change in output, a change in prices, or a combination of price and output changes. A change in real GDP always indicates a change in output. The differences between real GDP and nominal GDP are apparent in this figure. For example, look at the year 2007 and 2008. When output decreased and prices increased between 07 and 08, real GDP actually declined. But nominal GDP rose because prices increased by more than output decreased. When economists track any dollar-based measure over time, they use the real value, not the nominal value. This practice is so common that often the term real will just be assumed rather than stated. So, for example, when you hear a news report about GDP growth, it probably means real GDP growth.